This could be the worst recession the United States will ever face. Companies across multiple industries are massively laying off their employees. Amazon just announced that they will lay off 30,000 people. UPS is about to fire 48,000 people. And Intel, which was recently partially acquired by the government and is backed by the most powerful government in the world, is about to lay off 15% of its staff. And this is happening across multiple different industries. If this is happening to the largest companies across the country, what do you think is happening to small little private businesses? They are suffering, they are struggling. Revenues are falling down, costs are rising, even though that we are in the middle of the greatest revolution in history, the AI revolution. And this is just the beginning, because the big tech is preparing itself for a really worse recession. JP Morgan, Goldman Sachs, everybody is anticipating a recession. But this recession is going to be very different. What makes this recession so different from all previous recessions is that we did not have a recession since 2008 financial crisis. Prior to that, recessions were absolutely normal. In 2001, the economy crashed and then we got out of that recession. The only recession since 2008 happened was in 2022. But technically that wasn't actually a recession. That's because the global economy collapsed since we got a global pandemic, countries shut down their borders, and the economic machine began to slow down. But when central banks entered the economy with so much cheap money, we avoided that recession. And we have avoided many recessions because the Federal Reserve has been fueling the country with cheap money. One of the biggest indicators of a recession is the yield curve. When you borrow money or you provide loans to somebody, the longer the loan, the higher should be the interest rate. The shorter the loan, the smaller or the lower should be the yield on that. If you're buying a US Treasury for 1 month, you're not worried. The risks are very minimal. You will get your money 1 month from now. But if you have locked your money for the next 30 years, imagine how many opportunities you are going to miss. The opportunity cost is dramatically higher. There could be another AI revolution, but your money right now is being locked at the hands of the government and you can't use it in order to invest in the AI stocks. So you miss that opportunity, which is why you will demand a much higher yield if you're investing long term, if you're locking your money for the next 10, 20, or 30 years. And that's why this is how the yield curve usually looks like. Short-term government bonds provides you with a much lower yield. Longer government bonds provide you with a much higher yields. The moment the dynamic of this curve changes, that's when we have a problem. The moment investors start expecting a much lower yield on long-term government bonds than short-term government bonds, it changes the dynamic of the market, and that's when you have to ask yourself why investors are comfortable to accept much lower yields on long-term government bonds than short-term government bonds. This is how it looks like usually when the yield curve is inverted. Short-term government bonds, such as 3 month, 6 month, and 1 year, have a much higher interest rates than longer-term government bonds, such as 30-year government bonds. What usually determines the yields on treasury bills is supply and demand. If more people want to buy short-term yields, then their rates will be much lower. If the demand for short-term treasury bills is so low, then the government will offer a much higher interest rates to attract investors. And the same logic applies to long-term government bonds. If the demand for 30-year government bonds suddenly skyrockets, then the government is going to provide a much slower or a much lower yield. And vice versa. If there is very little demand for 30-year government bonds because everybody is excited about AI and everybody wants to invest in the stock market, they don't want to lock their money in the hands of the government for the next 30 years, then the government will suddenly start offering a much higher yield on 30-year government bonds in order to attract these investors. But in this scenario, investors are willing to lock their money for the next 30 years. And that's because investors believe that the Fed will cut interest rates due to slower economic growth. When the economy begins to slow down, when it enters into a recession, when a financial crisis is about to hit, the Federal Reserve is going to lower interest rates. But the new government bonds, because the Fed has lowered interest rates, especially on short-term government bonds, they will start offering a much lower yields. If we are entering into a recession and the Fed will keep interest rates very low, it's much better for me to buy long-term government bonds at a higher rate to lock my money so that I will continue earning 4% or 5% in interest every single year, because a month from now, my 1 month treasury bills is going to expire, and if I buy a new treasury bills, it will offer me a much lower yield, which is why as an investor, I will lock my money for 30-year government bonds so that I continue receiving a much higher yield on my investment. And that's why the moment the economy slows down and the Fed starts to lower interest rates, investors lock their money for 30-year government bonds. The demand for 30-year government bonds is going to rise, the yields in them is going to fall down, which is why we are going to have an inverted yield curve. Every single time that 3-month treasury bills had much higher interest rates or much higher yields compared to 10-year government bonds, we had a recession. In early 2000s, 3-month treasury bills had almost 3% higher yields than 10-year government bonds. So the economy collapsed and we had a recession. In early 2008, the exact same thing happened over here, and we had the Great Recession of 2008. And since 2008, 3-month treasury bills usually had a much higher yield than 10-year government bonds. The US economy is supposed to be in a recession since 2008 up until 2015 and 2016. But it did not happen because the Federal Reserve intervened in the economy and kept bumping the economy with so much cheap money that it prevented the economy to be in a recession. The Fed artificially helped the economy avoid a recession with cheap money, and not because the economy was actually growing. If it wasn't for the Federal Reserve, then the US economy would have been in a recession far longer than 1 or 2 years that it was back in 2008 and 2009. Starting in 2020, that rate has also been growing. Short-term treasury yields have been rising much higher than longer-term government bonds. And that's why the probability of a recession by April 2024 has risen by 70%. But since then, it has fallen dramatically because the Fed lowered interest rates in 2024 by about 1.5%. And now that number is rising again because the probability of a recession is rising. The difference between 10-year government bonds and 3-month treasury bills is almost zero. So the curve is basically flat. The moment it becomes inverted, then the probability of a recession shoots to 70 or 80%. And that's why so many big companies, so many investors are expecting a recession in the foreseeable future. A recession isn't actually that bad. It's very normal for the economy to go through a recession every 4 to 8 years. The economy starts growing, inflation starts growing. The moment we hit a point where inflation starts rising faster than the economy, that's when we should have a recession. Because at the end of the day, if inflation is rising and the GDP is growing, but the real economy is not growing, that's not what we want, because productivity isn't growing. The economy isn't growing. Yes, the GDP has grown. Yes, prices has grown, but prices has grown because of inflation and not economic activity. And that economic cycle was very normal until 2008. Something happens in 2008 that the economy stops getting into a recession, because every time we're hitting a recession, the Fed intervenes and it gives the economy an artificial boost, so the economy starts growing again. We hit a point where prices are rising much faster than the economy. We're supposed to have a recession. The economy is supposed to slow down. But then the Fed intervenes and gives the economy another boost, so the economy starts growing again. And that's why we avoided so many recessions over this period of time. In fact, if you look at what's happening right now, we're literally having every single sign that we're supposed to have a recession. If you look at the unemployment rate, it has been rising at least since September of 2023. Currently, it stands at about 3.3%. At the same time, inflation isn't solved at all. We actually hit a very good point in April, at 2.3% inflation rate. But since then, we got a new policy that the Fed will continue lowering interest rates. So the inflation rate this year will end up at around 3%, and the probability that number is going to continue rising within the next year to 4% is extremely high. If we have a 3% inflation rate when interest rates at about 4%, what do you think is going to be the inflation rate when interest rates will be lowered to about 3% by the end of next year, or even most likely by summer of next year? And there is also a probability that we are overestimating the jobs report. Remember the previous jobs report? They told us that we have overestimated the number of jobs between April 2024 and March 2025 by almost 1 million jobs. So the jobs report that we have currently isn't actually very accurate. The real jobs report will come up a few months later. 6 months from now, we might actually find out that we're actually been losing so many jobs and not getting so many jobs. So we might actually find out that all this time we have been in a recession, but we basically simply didn't know that we are in a recession. Imagine for a moment that the real economy grows by 3% and inflation is 4%. Yes, the economy has actually grown, the GDP has actually grown, but it actually has grown because inflation has been 4%. If you adjust GDP for price increases, then the real GDP has actually decreased by a single percentage point. The real question here is that why is the government and the Federal Reserve artificially pushing the economy and preventing it to fall into a real recession? That's because the United States is in a real competition with China. We are facing a serious threat that China is about to overtake the United States as the largest economy in the world. And the Chinese economy is growing much faster than the US economy. In 2025, the GDP of China will grow by about 5%, and the real GDP of the United States will grow by about 1.6%. Do you see the difference between 1.6% and 5%? If this trend is going to continue literally for about 7 to 8 years, China will overtake the United States as the largest economy. Is that something that we want to see happening? Well, of course not. And now stop for a moment and imagine what would have happened if the United States experienced 2 or 3 recessions over the last 17 or 18 years. Probably by this time, the size of the US economy would have been as big as the size of Chinese economy. And that's not the position that the United States wants to see itself. So the United States wants to continue pushing the economy to the point where it is going to emerge victorious out of this competition. Either the Chinese economy is going to slow down, or the Chinese economy is going to break up, or something will happen to the Chinese economy that it will give time to the US economy to slow down slightly, go through a period of a recession. Because if the United States did not save itself in 2008, by this time, China most likely would have been a much larger economy than the US economy, and that threatens the interest of the United States across the globe. What is a recession at the end of the day? A recession is basically 2 negative consecutive GDP growth. A GDP consists of a few factors. Consumption, this is what mostly drives the economy. That is when you are spending. Every dollar that you spend becomes someone else's income. That person takes that dollars, he also spends that money, and the more money we spend, the faster the economy growth. The second factor of the GDP is investment. When people realize, or people with money or investors realize that people are spending money, they want to turn their money into more money. So they would invest in Amazon, they would invest in business, they will bring stuff, they will sell it because there are people who want to buy it. There is real consumption. One of the main drivers of the US economy, or what makes the US economy so unique compared to many different economies, is because it's a strong consumer-driven economy. Everybody wants to do business in the US because people are earning money, they are spending. They're making money, they are spending. And that's what businesses usually love. The third component of a GDP is the government spending. And government usually is the largest spender in the economy. Currently, the US government is raising $5 trillion in taxes and borrowing an extra $2 trillion to spend. In total, the government is spending $7 trillion. It creates inflation on one side, but that spending is also driving the economy, is creating jobs, creating salaries, pushing people to have incomes and spend on those businesses. Final factor is net exports. So the more you export to other countries, the more money you are going to make. The more you're importing, the less money you are making. Because when you're exporting to other countries, you're earning money and bringing that wealth back into your country. But the United States imports far more than it exports. It's an import-driven economy. That is one of the main problems that Trump has with the US economy. It wants to fix the trade balances. Theoretically, in theory, if you fix the trade imbalances, it's supposed to grow the economy. It's supposed to grow the GDP. But not in the case of the United States. Because usually when we assume a net export, we assume that people making money in your country, then they take that wealth and bring it back to their country. But that's not the case with the United States. When a Chinese business brings stuff to the United States and sells it in the United States, they don't usually take that money and bring it back to the United States, to China. They take that money and invest it back into the United States because the United States is a consumer-driven economy. They will take that money and buy US stocks. They will take that money and invest in US treasuries. And that's why if you look at the US government debt, you'll see that almost $10 trillion of that is being owned by foreign nationalities, by foreign investors. If you look at the US stock market, you suddenly see that a huge portion of the US stock market is being owned by foreign investors. Not a single other country has so many foreign investors as much as the United States has. And that's why in the case of the United States, the fact that the United States is an import-driven economy, it helps the United States because investors investing, bringing stuff in the United States, selling in the United States, and then taking that money, investing it back into the United States, which keeps growing the US economy. And that's why when Donald Trump is imposing those high tariffs on foreign countries, that means that they will do less business in the United States, they will be earning less money in US dollars, and they will start investing less into the United States, which is going to slow down the GDP of the United States. So what do we have in conclusion? The US economy is slowing down while inflation is rising much faster. And what makes this recession so different from previous recessions is that we have accumulated multiple recessions. We're supposed to have so many recessions in the past, but we got out or avoided those recessions because the Fed artificially pumped the economy with cheap money. So this recession is going to be very different from previous recessions. Inflation is not going to stop. Usually during any kind of a recession, inflation stops because people have less money, they're spending less money. So naturally, inflation stops or it slows down dramatically. But in this case, our inflation rate is 3%. The Fed lowers further interest rates to about 3% or maybe 2.5% by the end of next year. Inflation goes back to 4% or 4.5%. On the other side, the GDP grows by about 2 to 3%. The economy is growing to a certain extent, but prices are growing much faster than the economy. Prices are rising for you, but your income isn't rising. So that is literally the worst recession for the middle class or for people who are living on a paycheck. There are a few things that you can do to save yourself. First of all, it's time to save money. I mean, you're supposed to save money and create an emergency fund way before 2025. But if you don't have that, now is the time to start saving money. Secondly, a recession is always an opportunity because even really great businesses are being sold at a discount. After the 2008 financial crisis, people got in and bought those houses at a fraction of the price. When the next recession is going to hit, a lot of these businesses are going to lose a lot of their valuations. So you can get in and buy some of these businesses and really profit from the stock market. So if you want to know what are the top 5 stocks that you should be buying now, then check out the first link in the description of this video. Thanks guys for watching, and I will see you in the next one.